Market Shots are short video segments designed to help you develop a trading strategy that you can stick with. Here to help you is the Chief Market Strategist for the Market Guys, A.J. Monty.
Hello and welcome to our next topic of discussion, which is hammer patterns. Hammer patterns is a common candlestick pattern that was developed a couple hundred years ago and identified by the Japanese rice traders mainly to point out a shift in the supply and demand. Now, what I'm going to do is just identify these patterns for you so you know what to look for, and also how to trade the pattern. You know, it's one thing when you can identify a pattern, but it's another when you really have to know how to trade it. Now, at the very bottom of this particular leg, and what I'm describing here for you in a leg is from this high to this low, and another leg would be from this low to this high. As a swing trader, your objective is to be able to trade the swing or the leg on that particular price action. A hammer pattern is generally found at the bottom of a downward leg. And you can see here, this is Microsoft. I've taken out the dates so as not to timestamp this recording too much. But you'll see that this is a series of red, very long red candles. And right at the bottom of this leg, you'll see there's a pattern right here that is a hammer pattern. Let me describe this to you. A hammer pattern is a very small body. You see the green action right there. The green body is very small, and you'll notice at the bottom of this green body, you'll see a very long shadow. The shadow is the vertical lines that protrude above and below that particular body. You'll notice that hammer patterns, when found at the bottom of a downward leg, when the lower shadow is longer than the body itself, and what we're looking for is a shadow that's at least 2 times longer than the body itself, that defines a hammer pattern. That is a very bullish signal, and one that will generally signal the pivot point to the next upward leg. So what I want to do is really show you how to trade this, and then I'm going to point out a couple more for you. When you identify a hammer pattern, what you can do if you're a risk taker is you can actually buy on that particular day. This is, again, for the risk takers. You buy on that particular day, usually within the last 15 minutes of the day, and then you put your stop right below the bottom of that shadow. You see, if there's a hammer pattern that does not work, it's a failed pattern, and it could mean much lower prices. So remember, most of the candle patterns I point out to you are going to be accurate about 80% of the time, but you have to prepare for the 20% of the time that they're not accurate. So what you do is you wait for the end of the day to make sure that pattern is going to sustain. You put your trade in this case you buy the stock, or if you're an option trader, you would do something that would make you long, either buying calls or selling puts, and then you put a stop right below. It doesn't have to be dollars below, it could be just a very small percentage below that low, and then you let the trade work out for itself. Now that's how you trade the hammer. Now you'll notice back here there's also a hammer pattern at the end of a downward leg. The big difference here is that this is a red hammer, this is a green hammer. The color of the body does not really matter. What does matter is that it's formed at the bottom of a downward leg, and that the shadow is at least 3 times or 2 to 3 times longer than the body itself. Again, you wait for the end of the day, you put your stop below that low, and then you just take your ride. Now, you'll notice that there are other points where you'll see a similar shape in the candle, but when that's not called a hammer, that's called a hanging man. A hanging man is a hammer pattern, but the only difference is it's found at the top of an upward leg. So right here you can see again long shadow underneath. The body is roughly a very small, narrow body, but the shadow is 2 to 3 times longer than the body, and you'll notice that this stock has come down after that hanging man has formed. You'll notice that there's another hanging man. This is very close to a doji, which we'll talk about another time. Here's another hammer pattern, but look, that one is not at the bottom of a downward leg, this is considered more to be a hanging man. Now let's go down a little bit more. You'll see here's a hammer pattern that you may have gotten stopped out of. Remember, 20% of the time you're going to see that it doesn't work out as planned, but here's a hammer pattern that actually formed at the bottom of a downward leg, a long shadow. In this case, you would have gotten stopped out on this day. You would have bought on that particular day, you would have put your stop below that shadow. On this day, you would have been stopped out. Don't worry about it. You would have lost very, very little. Just wait for your next hammer pattern, and you'll be in great shape. Be sure to tune in to the Q&A open house sessions with the Market Guys, which is the first Monday after options expiration Friday. Don't miss those. If you have any questions on these types of patterns, make sure you give them to me during that 1 hour session. It is interactive. We look forward to having you. Hope you enjoyed this session. Have a great trading day.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.